This is Trade Flow News, bringing you relevant news and insights from around the world. Trade Flow News, enabling trade for SMEs and economies worldwide.
Welcome back to Trade Flow TV. You know the drill, markets move fast, and if you're not ahead, you're under. It is Tuesday morning, June 9th, 2026, and we are entering the most volatile 72-hour window of the quarter for global macro desks. The massive gap between paper market speculation and physical supply chain reality is hitting a breaking point. Let's get you caught up for the opening bell. First up, the 60-second global macro flash. Brent hovers in the mid-95s. Brent crude futures are pinned between $95.30 and $95.50 a barrel this morning, with WTI holding steady near $92.80. Algorithmic paper traders are trying to price in short-term diplomatic chatter, but a massive physical floor remains completely ironclad. The inventory shockwave is driving the baseline. The U.S. Energy Information Administration notes that global oil inventories are free-falling by a staggering 8.5 million barrels per day in Q2 2026, locking in a hard Brent price projection near $106 a barrel for June. Meanwhile, the euro cracks its support level. The foreign exchange market is delivering a harsh verdict on the eurozone. The EUR/USD cross has fractured beneath its key 1.16 psychological consolidation zone, tumbling into a 1.152 handle. This forces the ECB to prep an interest rate shock. Ahead of this Thursday's meeting, markets are pricing in an overwhelming 97% probability of a hike. Finally, we are paying the Hormuz volatility tax. Systemic geopolitical risk is entirely driving asset flows due to the de facto closure of the Strait of Hormuz. Let us take a deep dive into how a persistent physical global energy deficit is trapping the ECB in an aggressive tightening loop. We are watching a profound structural divergence play out live on global terminals. Central banks are choosing between defending currencies or saving growth. Look at the physical supply vacuum. Do not mistake the recent daily chop in oil as a return to a loose market. The Strait of Hormuz is functionally irreplaceable. Because a full recovery will take months, the EIA expects global inventories to diminish by 2.6 million barrels per day. Energy scarcity is the economic reality. This traps the ECB into a fragile insurance hike. Eurozone flash inflation accelerated to 3.2% in May, driven by surging energy costs. This forces a recalibration phase. The central bank is practically locked into a rate hike because leaving inflation expectations unchecked is a systemic failure. Behind it all is the EUR/USD wrecking ball. The collapse of the euro from 1.16 down to the 1.152 range tells you everything about global capital flight. Here is the trade flow take. This week is about capital preservation. The ECB's imminent rate hike will place pressure on European cyclical equities. You need to stay heavily indexed to hard assets, maintain maximum US dollar liquidity, and avoid catching the falling knife in growth stocks. Stay liquid, stay sharp. See you on the next one.
That is all for today's news on commodity markets. Stay tuned to Trade Flow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at Trade Flow News, which allows you to watch our program on your mobile device or desktop to receive information from there.